Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. We'll be taking a look today at some TIGR trades, I'm terming it, where big repeat call buying in TIGR Up Networks, a Chinese brokerage firm, sets up ideally for a couple vol capture trades. One more of a neutral trade, one leaning bullishly with the big call buyer. So let's jump in and take a look. First, here's one of the scanners kind of highlighting. Here's the trades that come off. The big key here, right, is the volume to open interest change with a jump in implied volatility. TIGR certainly fit the bill here, as we saw big time volume come in on the March 10 calls, also some assorted other calls here, but certainly spiked the implied volatility as well. One of the other scanners I use here is that same name, right? Certainly coming up about 160,000 calls and puts. This is option volume traded on Friday, about 4 times the normal volume, 3.5 to be exact, right? And you see the stock did rise a little bit here, but more importantly, the IV jumped as well. The change about 24 vol points here at almost the highest levels we have seen over the past year. Earnings not for a while here, so not earnings related on TIGR as well. So let's jump in and take a look. First, here is one trade, a sell strangle trade, right? Which would be simply going out, playing those March options where the majority of the option volume, especially the call volume, came in, and doing a slightly bullish trade here, certainly at inception, selling an in-the-money March $9 put. The stock, and this is from Thursday's close, closed at 8.47, so the puts were about $1.50 in the money here, as you can see, are 0.5 point in the money here, and the calls, the March 10 calls, certainly out of the money by that $1.50. So selling an in-the-money put, out of the money call, a bullish trade. You'd be about 14 deltas net long by doing this. Implied volatility between the call and the put on average, just a little over 100. That strangle trading just under $2 on Thursday. On Friday, we saw that big volume. Here's all that March volume coming in here. You can see a lot of it in that March 10 call, even though there was previous open interest, right? You can see the March 9 call, the March 8 call, big volume, big repeat volume, building up that open interest. You can see also the delta now on that 9-10 strangle, simply because of the jump in implied volatility, giving a little lift to that upward drift in the stock price, which causes call deltas to rise, put deltas to kind of remain stagnant and fall. But it went from a bullish trade to pretty much a neutral trade now. You'd be 2 deltas short on the trade. More importantly, the IV jumped as we looked over 25 vol points on this particular trade. You would have gotten about 127 IV, and previously it was just over 100. More importantly, with the stock moving towards the ideal spot, right, which would be between 9 and 10, but it closed at 8.87. The stock was up 40 cents, right? But you can see that the puts are still in the money, the calls out of the money, but that strangle jumped over 40 cents, right? Or over 20%. Why? Because of this huge lift in implied volatility. So that would certainly be a straightforward kind of neutral way to capture that huge IV spike. How big a spike in IV you can see here over the past couple days with all that big repeat buying. IV now at the highest level since going back to kind of the sell-off we saw big time back in kind of mid-October, where you can see IV on TIGR certainly at the highest level in a long time. And here's from Thursday to Friday, we can see that jump in implied volatility, right? As we said, moving from right around 100 to basically 125. So that's a very straightforward way to capture that vol by going out selling the $9 puts, the $10 calls, basically a delta neutral trade. You'd be 2 deltas net short and just looking for that IV to revert. And remember, if it does, you'll probably see that price go back below that 192, right? Because the stock got closer to the ideal point, which would be between 9 and 10. And you can see that term structure volume, the big volume in the Marches, right? Over 43,000 contracts traded on Friday in the March. That's why we're kind of centered there. And earnings aren't for a while here out in March, middle of March. So you got basically a month. So certainly plenty of time for that IV and time decay, as we can note that as well, right? The time decay on these increased too. You're looking at 2 and 2, so basically about 4 cents of time decay a day on this trade, simply because of that big jump in implied volatility. And taking a look at another way to play it, this one even more straightforward, right? This is a simple buy right, buying the stock, selling those expensive calls. So took a look on Thursday before that big call buying that we just went over, right? You can see the stock at 847, as we noted, the March at the money, slightly out of the money, $9 calls, trading about 83 cents at right around 100 IV. And if we wanted to take a look at doing, right, a covered stock trade, which is simply buying the stock, selling the call, you could buy the stock around 847, let's call it 850, sell those calls at about 83 cents. So you'd be paying somewhere around 765 or so, give a few pennies on that trade with the stock at 847, deflecting in essence about 10% of the downside on the stock by doing it there. Then let's fast forward to the next day with that huge call buying. Here's all that big volume. You can see just massive amounts here, big repeat call buying as well. More importantly, that IV, which was right around 100 the previous day on those now closer to the money March calls, right now trading, at a 123 IV. More importantly, the price of the calls actually went up more than the price of the stock. The stock is up 40 cents. These calls up more than 40 cents. So even though they're slightly out of the money with roughly a 50 delta, give or take 56 because of the jump in IV, the call price went up more than the stock, which means that covered call trade, right, the covered stock, actually got cheaper in price by a few pennies. So for those who want to follow along, you can get into the trade cheaper simply because the stock did rise, right? You're closer having this trade work out nicely, right? But because the calls actually went up more than the price of stock. Why? Because the IV, due to that big call buying, caused that. So an ideal scenario, following along with that big call buying and taking advantage of the fact they're willing to overpay for it. So buying the stock and capturing that vol pop by selling the calls, leaning bullishly, right? You'd be about 44 deltas net long, right? Buying the stock, which is 100 deltas, selling these calls a little bit over 50. So hopefully provide some insight into how we go about identifying trades here. Until next time, as always, here's to good trading. Take care.